By the end of this video, you will have a clear understanding of what equity capital markets are and how they even function. You will understand who the key participants are and how capital moves from companies to investors and how investors evaluate opportunities. We will look at how issuers raise equity, how investment banks structure and underwrite deals, and how regulators and intermediaries support market integrity and execution. To start off, let's talk about what equity capital markets even are. Equity capital markets, or ECM, represent the part of the financial market where companies raise money by issuing stock, and investors purchase that stock to gain ownership in the business. So instead of borrowing through debt, companies are using equity as a way to fund their growth. In ECM, there are several key participants who help make this process work. First, we have the issuers. These are the companies looking to raise capital. Next, we have investment banks, who act as the bridge between companies and investors. They advise on pricing, structure, and timing. Then we have the investors, ranging from asset managers and hedge funds to pension funds, who are providing the money and receiving shares in return. We also have the regulators, such as the SEC and FINRA, who ensure fairness and transparency in the market. And finally, intermediaries like exchanges and custodians, who facilitate the actual movement and settlement of shares. The reason ECM matters is because it plays a critical role in corporate growth and market development. Equity capital allows companies to fund expansion, hiring, and acquisitions without taking on debt obligations. It also helps broaden their investor base, which increases liquidity in the stock and builds long term credibility in the public markets. For companies with larger ambitions, whether that's going public for the first time or continuing to raise capital after an IPO, ECM is what supports that long term value creation. First, we have the issuers. These are the companies seeking to raise money by selling shares, and they're the starting point of any equity capital market transaction. To put it simply, they are the businesses that issue stock and raise money by selling shares. Any industry or company can issue stock, such as those listed below. They raise cash through three main ways. The first way is through an IPO. An IPO, which is called an initial public offering, is when a private company sells shares of its stock to the public for the first time. They are basically trading their ownership for cash and to make their company more visible. The second way is through follow ons. A public company that issues more stock repeatedly is an example of a follow on. The third way is private placements. A private placement is when a company sells shares privately to a small group of investors instead of the public. Companies do this during early stage growth, restructuring, or before the preparation of an IPO. We have the investment banks. They are very critical in facilitating the shares between the issuer and the investor, and they plan, price, structure, market, and distribute those shares when a company wants to raise money. To put it simply, they are the intermediary between the issuers and investors and help companies sell stock and help investors buy that stock. There are many teams within the equity capital market subsection. We will go through the ECM team, the syndicate, IBD coverage, sales, trading, and prime brokerage, and how they provide services. To start off, the ECM team help companies issue new stock. They design the equity offering, such as the structure of the deal, the type of shares, and the amount they will issue it in. They turn the client's goal into a market-ready transaction. Next, the syndicate manages the process of distributing shares to investors. They connect the deal with investors across multiple banks, collect the amount of demand investors have, also called the order book, allocate shares to investors fairly, and help set the final price of the IPO if they are issuing one. They make sure the offering is successfully sold and allocated to the right investors at the correct price. Next, we have IBD coverage. They advise companies with different aspects of their operational elements. They manage relationships with clients, understand the company's goals, strategy, and capital needs, and pitch financing solutions to them. They also help with M&A, which is not too important to know in this video. Next, The sales team talk to investors and find clients to buy shares. They pitch the offering to institutional clients such as hedge funds and asset managers. They communicate how investors are feeling back to the ECM and syndicate team and maintain investor relationships. They find buyers and create demand behind an offering. Next, the trading team buys and sells stocks for clients directly and stabilizes the stock. They execute investor trades during and after the deal, provide liquidity so the stock trades smoothly at launch, and manage price stabilization after the IPO is listed. They make sure the stock does not collapse and help it trade efficiently. Lastly, we have prime brokerage. They are mainly important to hedge funds because they provide custody, financing, and leverage. Third, we have investors. Simply speaking, they buy the shares that companies issue. Investors can be asset managers, hedge funds, insurance companies, pension funds, retail brokers, which are the online platforms normal people trade on, and more. There can be many reasons as to why they buy stock. One of the reasons can be to hedge inflation. Hedging inflation means to invest in things that usually go up in value when inflation goes up, so that your money does not fall behind. They also invest to gain partial ownership in a company, receive dividend income, and take advantage of mispricing. This means buying or selling an asset when its market price is temporarily wrong compared to what it should be worth, so that companies can make a profit when the price corrects. And lastly, to gain liquidity. Fourth are the intermediaries. To simply put it, they are systems that help the stock market function. Intermediaries include exchanges, depository agents, and custodians. These facilitate trading. First, exchanges are the marketplaces where stocks are traded. They provide the platform where buyers and sellers trade, list companies and maintain listing standards, and publish data, such as the volume that's being traded and what trading activity is going on. Examples include the NASDAQ and the New York Stock Exchange. Second are the depository agents. These are middlemen that connect investors to the depository system. They help investors open accounts to hold stocks electronically, process transfers of shares, and communicate corporate actions such as dividends and splits and rights issues. Lastly, we have custodians. They store and protect securities on behalf of big investors, keep ownership records up to date, and make sure trades settle correctly. Lastly, we have the regulators. These are government agencies that make sure everything is happening legally. These include the SEC, FINRA, Department of Labor, and CFTC. They regulate the process. First, the SEC is a US government agency that helps regulate the stock market to protect investors. FINRA is a self regulatory organization that oversees all the brokerage firms and brokers in the US. The Department of Labor is a government agency that protects workers' wages and retirement plans, and the CFTC regulates derivatives, which includes futures, options, and swaps. Let's recap everything we now know. The first step of the process includes the issuers, then the investment bank, investors, regulators, and lastly the intermediaries. The issuer asks the bank to help raise money in shares through the three main ways we discussed. The bank then distributes those newly issued shares to investors through the sales and syndicate team. Investors pay for those shares and provide that capital to the investment bank first. The bank then sells those shares and returns the money raised to the company. The intermediaries help facilitate every single part of the process, making sure everything is tradable. The regulators make sure everything is happening legally with no manipulation involved. We just finished discussing equity capital markets. We talked about what they are, who the core participants are, and how they interact to make the system work. We saw how issuers, investment banks, investors, regulators, and intermediaries are all interconnected, and how ECM turns ownership into capital to support growth.